Good morning, ladies and gentlemen, fellow shareholders. Delighted to have a physical meeting after a 3-year gap and to see so many familiar faces. So Personal Assets, just a reminder, it's an unusual trust which is here very much for shareholders to entrust their irreplaceable capital to us for the long term. We try and align our interests as much as possible with our investors, as does the board, and that has always been the case. As Francis mentioned, we've had a discount control mechanism now for over 20 years, and I'm pleased that others have followed, particularly the two trusts, and the boards of those two trusts have entrusted us to make that decision, which has been very much to shareholders' benefit. You will have seen in the report and accounts, which was published, I think, earlier this month, that Personal Assets is proposing a special dividend, which I'll come on to a little bit in my presentation, and also a 100-for-1 share split, subject to shareholder approval at the AGM in a couple of weeks' time. In the latest Money Week podcast, Dylan Grice, a well-known commentator and strategist, described PAT and our multi-asset approach as a cockroach portfolio for all seasons. I'm not quite sure if that was flattering, but it shows you that I think that PAT is about winning the battle of investment survival rather than maximising the upside. So the world has changed. After 13 years of what I've described as the phony financial world, we're beginning to see reverse that. We're beginning to have a painful journey in terms of a return to some semblance of normality. On the left-hand side of this chart here, you will see the Fed balance sheet in red, and you can see how during COVID in 2020, the Fed expanded its balance sheet by 2 times. But there's a very material difference from the very material increase during the financial crisis in 2009, which is that effectively this time around in 2020, we've had what some commentators have described as modern monetary theory light, or MMT light, whereby before printed money found its way into asset prices, this time around, due to fiscal stimulus, it's now boosting retail prices, which has very material implications. And what that means is we're moving into a new regime of higher interest rates and arguably higher inflation. I'm reminded by Sir John Major's phrase, "If it isn't hurting, it isn't working." And this is not some sort of brave new world, but rather actually a return to normal and the reality of a higher cost of capital. The era of concept capital, where free money flowed into profitless technology companies and growth, has, we feel, come to an end. This has been a difficult environment, a reset, if you like, that began earlier last year and has run through markets for the last 18 months or so. On the right-hand chart, you can see the US debt to GDP, which is at World War II levels following the pandemic. US government debt has increased threefold from $10 trillion to $10 trillion in 2008 to $30 trillion today. So it will take a long time to normalize. Quite clearly, central banks cannot normalize interest rates to the sort of levels that we were used to prior to the financial crisis very quickly. So one thing that will not change is, in my opinion, is that financial repression is here to stay. And what I mean by that is negative real interest rates. And you can see that here. The UK RPI number, which last month was 11.7%, compared to the very, very modest increase in interest rates that the Bank of England has put in place from 0.1% in 2020 to 1.25% today. That gap is the widest since the 1950s. And I think it highlights central bankers like Andrew Bailey, the governor of the Bank of England. They're in an invidious position. They tackle inflation by raising interest rates, but that leads to weaker growth. And he showed the weakness of his hand a few months ago by calling for wage restraint. something that the RMT didn't really get the memo. He knows that tightening with such high debt levels will tip the economy into recession. But if wages become ingrained, wage growth becomes ingrained, then future inflation becomes more embedded. Effectively, they are between a rock and a hard place and in a trap of their own making. So this era of negative real rates is here to stay. The idea of some Paul Volcker from the 1970s and 80s, the chairman of the Fed at that time, moving to positive real rates, we think is simply unpalatable, despite all the talk of it. So the pandemic bubble, which was fed by QE and zero rates, the second bubble in my career, is now deflating. Valuations have fallen from their peak in November 2021. This is the cyclically adjusted price-earnings ratio. It's one I've used many times at Pat. You can see there, hopefully, there we are. So this is the peak during the dot-com bubble here in December 1999. The PE on the US stock market over 10 years of earnings was 44 times. In November 2021, it was 38. And since November, it's fallen by 10 turns to 28 times. So it's begun its journey downwards in terms of valuations. Now, stock markets, historically, as they did in 1999, peak in periods of modest inflation, very low interest rates, loose monetary policy, and high expected growth. Today, we have rates rising, we have rates rising, we have rising inflation or high inflation, and we have declining levels of growth. This is not a great combination for stock markets. And you can see here, actually, the long-term fall in the long-term bond yield, which is the red line, which peaked in 1982 when real yields were positive, has been falling for the last 40 years. And you can see there the trend has broken and long yields have started to rise. In some more speculative areas of the stock market, as we've seen, falls have been pretty savage. But there's a material change to what happened in 2000 and in 2008, is that there are actually fewer places to hide after 10, 13 years of QE than there were before, because bonds are falling with equities. So for the past 40 years, during that fall in the 30-year bond, the 60-40 portfolio has been a phenomenal place to be for private investors, for family offices and institutions alike. And effectively what this provided, this 60% equities, 40% bonds, it provided a sort of yin and yang. So when equities performed poorly, bonds tended to perform well. And what you got was the green line here, which is really good risk-adjusted returns of about 6.6%, but with annualized volatility of just under 10%, 9.5%. Whereas if you look at the equity return, it's not that much higher, 8% a year, but you've had annualized volatility 50% greater at 15% a year. So actually, this was a wonderful combination for investors. But unfortunately, that combination is now turning toxic as bond yields rise and equities fall. In previous bear markets, particularly during the dot-com bust and during the financial crisis, that barbell worked incredibly well. And you can see the low volatility of the green line compared to the blue line. It provided a great deal of comfort. And unfortunately, this time around, there is no bond insurance to portfolios. You can see that in the performance year to date of equities and bonds, both down. And commodities, gold and cash have been the only game in town for those seeking protection. And to put this into context, personal assets is down 3% year to date on a total return basis. So how on earth do we navigate this new, very challenging environment? Well, for Troy and for our multi-asset portfolios, like personal assets, it begins with careful stock picking. The best way to preserve, in terms of preserving and growing capital in the long run, is aligning our portfolio with management teams who share the mentality of building the business over a long term. And in personal assets case, we very much build a portfolio from a bottom up, from an equity perspective first, and then we complement the other assets. In the past, those have been bonds, gold, and cash. Today, it's more about index-linked bonds rather than fixed income, and I'll come on to explain why later on, but hopefully that should be obvious. And we've always had a very careful qualitative stock-picking approach, which all of us, the 14 of us in our investment team, which Francis alluded to earlier, all very much believe in and work towards on behalf of our clients. As I mentioned, we don't hold conventional bonds, but there are other asset classes which complement the equities and offset the equity risk. First, TIPS, Treasury inflation-protected securities, but also gold, which I'll come on to talk a little bit about, and cash. And cash is dry powder. What was remarkable is when inflation starts to rise, many investors said, well, the one place you don't want to be is cash. And actually this year, that's precisely where one should have been, because all other asset prices were overextended. So I think what we're trying to say here essentially is that we keep it simple from the point of view of personal assets. We don't use exotic derivatives. What you see is what you get. On the left-hand side here, you can see a carve-out of the equity performance of my mandate, the multi-asset mandate, going back to 2001 when we launched the fund. And clearly, personal asset shareholders have been beneficiaries of this since we won the mandate in 2009. But I think what it demonstrates is that we are good qualitative stock pickers, and importantly, we endeavour not to overpay. So roughly over the last 20 years, 60% of the returns in this mandate have come from equities, but 20% have come from fixed income, index-linked, and then some from cash, don't forget foreign exchange, and gold as well. So what makes Troy different in the terms of how they go about picking stocks? Effectively, very importantly, since I launched this mandate back in 2001, we have had a high hurdle in terms of investing in companies. We are careful in the companies that we select. We do not want to invest in wasting assets. We don't want to invest in companies that are challenged by technological disruption. And importantly, we're not traders. We like high-quality businesses, durable franchises that have been around for a long time and will continue to be around for a long time in the future. We avoid excessive debt, cyclicality, capital intensity, companies like retailers, airlines, and banks. Now, usually at this stage in the presentation, I start talking about British Airways, or IAG as it's known, which has been a dismal investment since I started in the city. But I thought today, for a change, to bring the changes, I thought I'd use Marks & Spencer. And on the right-hand side, you can see very clear reasons as to why we don't invest in M&S. To remind some of you, Marks & Spencer share price peaked at £7.80 in 1997. So it hasn't been a great investment. Today, it's about £1.50. But in terms of metrics, you've got return on invested capital, which is in single digits. You've got margins, which are in low single digits. You've got debt, which is high, 4.5 times. Often mature businesses have excessive debt, which leads to lack of flexibility. You had a drawdown during the pandemic, share price of over 50%, clearly something we don't particularly want. And finally, due to the Ocado deal that they did a few years ago, they increased the number of shares in issue by 15%. We like companies that are very careful with their equity and don't dilute us. And actually, it was a very big test for us during the pandemic. None of the companies, the stocks that we hold in personal assets at the time, raised new capital or needed to raise new capital, whereas many companies did. Compare that to a core holding that we've had since literally within a month of taking over the mandate of personal assets at Nestlé. High double-digit margins, strong operating margins, net debt very comfortable, a drawdown during the pandemic of a mere 6% in sterling terms, partly thanks to the strong Swiss franc. And then look, almost most importantly, number of shares in issue down 10% over the past 5 years. Compare the right hand with the left hand. Nestlé's up almost 60% over the last 5 years. M&S is down 50%. I think Nestlé is about the closest you can get to a cockroach stock. Moving to the rest of the portfolio, I mentioned TIPS, Treasury Inflation Protected Securities, and here you can just see the difference between what a TIP gives you compared to what a conventional bond gives you. On the left-hand side, you can see you get your principal back in 10 years' time, not protected by inflation, and you get your income, which is not protected by inflation either. On the right-hand side, you've obviously got, if you have 5% inflation over 10 years, you get 63% gain on your capital in terms of your principal, and also a gain in the income as well. And this is the reason to note, if you're reading the accounts, why we paid a special dividend, because effectively the income and the capital growth, which is actually counted as income, rather irritatingly, that boosted the income account very materially last year, and that was the reason for paying the special. But importantly, currently TIPS are yielding plus 1%, so plus 1% real. So we think that they still will provide good real protection in a period of higher inflation. It's certainly better than conventional bonds. And then last but not least, gold, which remains a core holding but not a permanent one. And while real yields remain negative, gold remains essential portfolio insurance, especially when bonds are not up to the task. Now, some might say, well, hasn't gold been a bit boring recently? And I think the answer is yes and no. Depends what currency you're looking at. And most people look at gold in dollars, and that may or may not be a mistake. This is a chart on the right-hand side of the four major currencies which are of note: the yen in green, sterling and the euro in red and blue, and the dollar in gold. And what you can see here is that in most currencies, with the exception of the US dollar, gold has been very resilient this year, up 10% in sterling terms. So effectively, in a period where markets are febrile, falling, it's doing its job for us. And the test over cryptocurrencies, for now at least, seems to have been won. Crypto has been highly correlated with the NASDAQ and other risk assets. Gold has proven to be a store of value over 6,000 years. Crypto still remains unproven after 13. So finally, where are we? We are very defensively positioned. As you can see on the left-hand side, we've got 35% in equities compared to a range of 31 to 74 over the last decade or so. We decreased our equity exposure before these recent falls, taking it down during 2021, not by enough, I hasten to add, but in hindsight, but still we did prepare for more difficult markets, and the balance obviously at relatively near highs in terms of the index-linked bonds, both gold and cash, having our dry powder ready to exploit opportunities as they present themselves. And I think we are at the bottom of the range in terms of equities now. I would expect and hope that our equity exposure will rise over the next 18 months. Now, what of the outlook? Francis always says at this point, Sebastian, you must offer a bit of hope, even if it's a sliver. We may be in capital preservation mode at Pattern. As you can see, I think that's appropriate. But today, there's good news. Falling markets do offer better valuations. The stronger businesses, as we are seeing, are surviving and thriving. Future returns, actually, from lower markets mean improved returns. That's what happened in 2001, 2002. It's what happened in 2007 and 2008. In 2008, when the CAPE was at, cyclically adjusted PE was at 15 times, I've mentioned earlier, today it's 28, we were 75% in equities. So it gives you a flavor of the fact that we can really pivot the portfolio when the value is on offer. So the equity allocation will depend both on what's available within equity markets overall in terms of equity indices, but also specifically in the kinds of companies that we like. And what you've got to realize, and what we've got to realize, is that as stock markets fall, we become more optimistic, not more pessimistic.